Hello, good morning and good afternoon. It is 7:30 Washington time and we are going to start in time. My name is Nina Arnhold. For those of you who do not know me, I'm one of the two global leads for tertiary education at the World Bank, and my colleague Roberta Bassett is going to connect for this session as well. Today's session is co-organized by the World Bank's Higher Education Group, by ECA Education, and by the Higher School of Economics in Moscow. And we would also welcome all friends and colleagues who connect from outside the bank, especially, of course, our colleagues from HSE. Thanks a lot for partnering with us on today's event. Today's webinar is part of a series of events. Since 2018-19, we started doing clinics and webinars on particular topics in tertiary education. There has been one clinic on funding where we touched upon income-contingent loans. However, we collectively feel it is a topic which deserves more attention, especially at this point in time. Due to the crisis, higher education funding systems are under pressure, and this applies to primarily publicly funded and also privately funded systems alike. So we are all keen to learn more about income contingent loans today, also as an instrument which could help us to handle the challenges during this crisis. I will introduce our speaker today, Bruce Chapman, in a moment. However, just to talk quickly about how we will go about today's session, we will have a presentation from Bruce, and if you have questions coming up, please send them to me. There is a private chat function in webinar, so you will see your name on the right side and a chat option next to it, and there you can select private. Nina Arnhold, please send me your question, and I'm going to collect the questions and bundle them a bit, and we will ask them at the end of the session. We have with us today Bruce Chapman. And Bruce, we are really honored that you were able to take the time. It's a fantastic opportunity for us. I think everyone knows you, but I'm going to introduce you nevertheless. Bruce is a professor of economics at the Australian National University, and he's he's the main architect of the HECS system, the Higher Education Contribution Scheme loan system. And for his achievements, he received the Order of Australia in 2003. He has worked on this scheme with various governments in Australia, but not only in Australia, but also a couple of other countries, including UK, Ghana, Hungary, and New Zealand. We will hear more about this work in a minute. However, I would also like to mention that we invited two discussants for today's session. You know Harry Patrinos very well, who is our manager in the ECA region. We also asked Lorraine Dearden, who's a professor of economics and social statistics at University College London, to join us today. Thanks also to you, Lorraine, for making it possible. And Lorraine, together with Harry, are going to comment after Bruce's presentation. So Bruce is going to present, and Harry and Lorraine are going to comment. I will raise the questions which you are going to send to me, and we will have some time for discussions. That's the plan for today. Just a final reminder, please switch off your microphone if you don't speak. You might also want to switch off your camera. Please send me your questions. And Bruce, the floor is yours. We are looking forward to your presentation.
Thank you so much for organising this, Harry. I appreciate it very much. I wanted to begin by acknowledging the contribution of Professor Roberto Urdaneta, who I had been working with closely for 12 years. Roberto was one of those people who cared very much about the welfare of higher education, particularly the access issues in Colombia. And very sadly, he died several months ago. Education financing. Sadly, there's still work to do there, but Colombia, the position they are in, which I think is a propitious one, without Roberto's commitment and unselfish engagement. I thank you, Roberto. So I say good morning to people in the eastern part of the United States. And good afternoon to those. Good evening to those in Australia and other parts of Asia. And this is a very strange thing that we've all been brought together in a way that has meant that we're kind of all completely apart. I would say that there is no doubt that COVID-19 has meant that this is the hardest possible time in the history of student loans for people who have a normal student loan, a time-based repayment loan, or the kind of systems that still exist in most countries. I would also be the best time for students to have an income contingent loan. And the reason I make those two grand statements is that the huge recession that is now upon us, which will be in which expected employment rates and probabilities of graduates on student loans will be very adverse. A little bit like, but much more severe than what happened in 2008, 2009. And what that means is something extremely important student loan system. Because if you've got a student loan, a college loan, a debt that has to be repaid without sensitivity to your capacity to repay, then you're in trouble. And you're in trouble because you won't be able to afford it. And those troubles will never be as severe as we're about to experience. And that's why an instrument, because unlike mortgage type loans, they offer insurance. So if you're lucky enough to be in a student loan arrangement where repayment as a graduate depends on your capacity to pay, you have no worries about default because of COVID-19. You have no worry about payment hardship of this loan if you're unemployed. The real worries is if you've got an obligation that does not take into account the exigencies, the adverse exigencies that will confront you outside of you as a student, your control, such as the macroeconomic implications of COVID-19. Background, next slide please. Harry Patrinos is being my very fine friend and moving the slides on for me because I just don't know how to do that. Let me summarise the world loan in 2020.
Harry, do you want to help us with the current slide for now until Bruce is reconnected?
I'll do that, and if I get things wrong, Lorraine can interrupt. So we're on the slide that says, is there a case for charging university tuition? There are 3 points here. One is on what does higher education, pre-higher education really mean? Someone is, after all, paying for it. If you're not paying for it directly, you're paying for it through the general taxation system. Second point is the returns to higher education. The wages that someone earns as a result of going to university or college today are higher than they've ever been, and we'll see a picture of that. There's also the third point that not charging tuition is actually a regressive policy and inequitable, and we'll see a quote on that. Here are some age earnings profiles showing the point about the high private returns to university education, in this case from the country of Vietnam. And you can see the solid red line shows at first people with university compared to those with high school earn about the same, but then at some point in one's career, the earnings for university education go up considerably.
So I think we're in a part of the discussion which is asking about the equity of not charging for higher education. The age earnings profile's there of Vietnam. Can you move on, Harry? South Korea, we've basically got men and women, people with tertiary degrees by age and income, and we also have Colombia. Next slide, please. All around the world, the private rates of return to higher education are very significant. And one reason that many economists think that that's unreasonable to have zero charge is that it's regressive, essentially. The charge is paid for by all taxpayers. And this was recognised by Karl Marx a very long time ago in 1875, who basically said, if you make it free, then you're essentially subsidising the bourgeoisie. I think that that's been a position that most education economists hold. And let's move on, please. Next slide. One of the most important issues that I think we've just started to understand that is related to public sector university funding is if there is no charge is replaced by a charge, this has two important effects on public sector governance and public sector expenditure in the system. Number one, there will be more finances available to expand the system. And number two, and this is really very important, there will be lower costs for the government budget per place. And what that means is that governments can spend less money and get more places in the university system. The evidence from Australia, the United Kingdom and New Zealand is completely compelling on this point. And this is it's a critical issue for access because small systems that are elite basically will exclude the relatively disadvantaged. So if you want to do something to help poor people's access to higher education, a big public sector system is the most important single thing you can do. And for the reasons that I've explained there, I hope that means a tuition system actually, oddly and counterintuitively, is much more likely to be advantageous to the poor. But I'll add a qualification, which is so long as the loan system in place is such to encourage and not disadvantage people's access. Next slide, please. These are the countries that have free higher education. Just to give you an international sense of this, I use the word free in inverted commas because we all know there is no free. Free means free to the students at the point of entry. So it's fairly common that about 1/3 of countries do not have charges. There are a few examples, Norway, Scotland, Sweden. But tuition is much more commonplace, and that exists in just the examples of the countries I've had there, just to give you some context. Next slide, please. The next question I want to address is, why do we need student loans? Well, why don't we just leave it to the market? So if you don't have the money, just go to the bank, get a loan and say, look, I'm very talented and motivated. Will you please give me a loan to pay tuition? The banks will not help you without a guarantor. And there are two reasons related to this. It's a very risky investment. In my country, for example, 20 to 25% of students who enrol don't graduate, even though they might have expected to. And that means that they can end up in jobs that are not good jobs in the short run without enough money to pay back a bank loan. And that can lead to default. Other things can happen which are beyond anyone's control. Let me give you a potent example. COVID-19, it's there, the recession is here, it will be profound. And those students, if they had a bank loan without a government guarantee, the bank would be in trouble. And why is the bank in trouble? Because there's no collateral. It's not like a house where the bank actually owns the house. So Nicholas Barr is fond of making this point. The bank cannot own and sell a student's brain. and we know that that is true. And that's the basic problem. That's why every country in the world that has banks involved offers guarantees of one form or another that the government will pay in the event that the student does. That protects the lender. It does not, however, protect the borrower, the student. There are two types of loans, as I said right at the beginning. Time-based repayment loans, which are most common, US, Canada, Colombia, China, and Japan, and increasingly more widespread income-contingent loans, whereby people take the loan, but they pay in the future, but when only if they earn above a particular threshold. These exist in Australia, New Zealand, England, and Hungary, and in various partial forms in other countries like Japan, Brazil, and the United States. Next slide, please. Let's ask the question, what is a time-based repayment loan and what do they actually mean for the borrower? The major point about this, and this is always the major point about trying to understand student loans, it comes down to the collection arrangements. So the time-based repayment systems, and I've just mentioned three there, Stafford, fees, and Isatex, the repayment obligation does not vary over time. With Stafford, for example, you have typically a 10-year period to pay back the loan in full as a constant nominal amount, and it doesn't vary at all over time, and that's the critical point. What this means that since some students or former students and graduates can have periods of very low income, for example, like right now, if they just graduate because there won't be jobs, they can experience great hardships of repayment. They might be able to borrow from their friends and family. They might be able to borrow at extraordinary interest rates on the private loan market. All of those possibilities are there, but they're not very attractive and they're very difficult. And for some people, it will just mean default. And default is extremely important because with default is a loss of credit reputation. So if a student defaults on a loan, the first thing that they'll be asked when they next go to the bank to borrow for a house is, have you ever defaulted on a student loan? And everybody will know, and it's completely straightforward for the bank to find out. So that means that their access to credit, for other forms of credit, is now seriously compromised by the defaulting on a student loan. This could affect their financial lives for decades. At least it will until they re-establish a credit reputation. The other point about defaults is it means that when somebody is declared in default, the government stops collecting the debt, which means that they can have profound effects on future revenue streams of debt repayment. They're also very inefficient to collect. If you want to have a bit of a look at this, go to any country and kind of hang out outside their student loan offices to see the large queues of people trying to get some kind of short-term forgiveness from the very large number of bureaucrats who are administering the loan systems. I've seen this writ large in many countries. I always go to Isatex loan office in Colombia, and by 9 o'clock in the morning on a typical day, there'll be hundreds of people trying to get some kind of arrangement where they don't have to pay because they haven't got the money. So it's very inefficient in public sector governance terms. Next slide, please. This is a poster from Canada Student Loans. You may not be able to read it very clearly. I actually took this poster. I'm not sure I stole it because I asked permission for it, although I probably wanted to steal it, just to show the difficulties that students might confront with a normal time-based repayments loan. Now, on the poster on the right, you can read the French on the left if you like. On the poster on the right, it says consequences if you don't. And the very first point is the one I've been making, poor credit reputation. So students are aware of this, which means that if they're not sure about the future, and we're not sure about the future, how many people 6 months ago expected the world to look like it does now? Nobody knows about these things. Then there'll be anxiety. Even for the people in Canada who are fine, there is that anxiety that you'll lose your credit reputation. It is a profound issue. Next slide, please. Income contingent loans, and what are they and what do they mean? They're odd things. They're not like normal debt. If you have a repayment obligation which is income contingent, you could pay it off in 3 years if your income is, or you could never pay it off. And we have both examples in the Australian income contingent loan scheme. Young lawyers will typically pay their debts, which are about 25,000 Australian dollars or 18,000 US dollars in about 3 years. And some people who spend a lot of time outside of the labour market, for example, will not pay at all. So if the way you think about this, the notion of income contingencies, the antithesis of mortgage type loans, which depend just on time. So in Australia, for example, if you earn in the future less than 47,000 Australian dollars per year, you don't pay anything in that period. That's about $40,000 US, which is slightly less than the average income. That means that there are no repayments if you're unemployed. So if you're unlucky enough to graduate in the next 1 year and not get a job, even if you've got a good degree, it doesn't matter. There is no repayment. If you want to look after a child and you don't want to pay, and it comes out of your individual income, it does not matter. If you've got sick parents that you want to look after and you don't want to pay back your student loan because of that, because of your low income, no action is taken. Some people are just not that aware of it. And that's kind of a benefit of it all because it's associated with a lack of anxiety about non-repayment. That doesn't mean the government doesn't get the money. It just means it gets it differentially with respect to the future lifetime incomes of the graduates. And they're all different. So the point again, no repayment hardships with income contingent loans, no defaults. That's the most important word to understand with income contingent loans is the word insurance. It means that if there are things beyond your control in the future, and that's a lot of things, it doesn't matter financially with respect to your student loan obligation. The other point I'd make is that we've found out, we didn't know this would happen, but after the system was introduced in Australia, it turned out to be extremely straightforward to collect the debt because it's just collected from what's called employer withholding. The same way that income tax is collected, the same way Social Security is collected in the United States and in the UK, the same way in which medical insurance is collected in many countries. So asking employers to take out some sums of money to repay student debt, depending on their income, is something they do all the time. In automated systems, it's extremely straightforward. And it was one of the big lessons about public policy that with this system, because of the nature of collection, it's extremely efficient. And when you think about the economics of this, it's very important to understand that the government has the capacity to deliver both consumption smoothing and protection against defaults, which is very easy to administer and pretty much close to the cost of nothing for the budget. Next slide, please. One of the most important things that have been going on in a research context over about the last 10 years is a calculation of what are known as repayment burdens. The repayment burden is a very important concept when understanding student loans. And let me explain what it is. It's on this slide. It's the proportion of somebody's income that they need to repay a loan. And that ratio will change for everyone with a loan all the time because our incomes change all the time. So if we ask the question, how big is this ratio for people? It's only a question, and I'll explain this in a minute, it's only a question that's relevant to time-based repayment loans. That is, the ones that I've been talking about that take no account of capacity to pay, the ones in Colombia, the ones in the United States, the ones in Canada and Thailand. So colleagues have looked at maybe 15 different countries and asked the question, for those kind of loan systems, what do these repayment burdens look like? And we've now got the next slide, thank you, Laura Lee, which shows our calculations. There's no point in doing these sums at the average. The average is extremely uninteresting. What really matters is the people with the relatively low incomes. So in all these exercises, we've looked at the people, the graduates by sex and by age, who are earning in the bottom 20% of graduates aged 23 to 31, which is typically when most people graduate. So let me try and explain this picture. These are about 8 countries, 10 countries. We've got on the y-axis the repayment burden, the proportion of their disposable, it's actually before tax income, that is needed to repay the kind of loan they would have in those countries, which all have time-based repayment loans. And the striking thing about these numbers is how big they are. So let me just take one example. In Brazil, the calculations reveal that for men in the bottom 20% of male graduate incomes of that age will need to find about 70% of their income to repay the visa loan repayment obligation. For women in Brazil, that ratio is over 100%. And what is striking is that those data, the extent of these extremely high repayment burdens, are true for countries that are very, very. The US is a high income country, and those repayment ratios for the bottom 20% of the graduates for Stafford loans are 90 to 100%. In other countries, again, quite different ones. So the big picture to take away from this is that repayment burdens are very difficult, are very arduous for very large proportions of graduates in time-based repayment systems, and that's an international finding. And that's what's going to lead to hardship of repayment, and that is what explains the default levels, which I'll talk about in a minute. Next slide, please. I think we've missed a slide. No, we haven't. With income contingent loans, and this is kind of a hard point to get if you've never really thought about income contingent loans, this is a strange thing, because the so-called repayment burdens of an income contingent loan are set by legislation. They're set by law. So the law in Australia says for our income contingent student loan, no person will ever pay more than 8% of their income in any one period to repay the loan. In New Zealand, that number is 10%. In England, that number is 9%. And in Hungary, it's 6%. These numbers are striking when we compare it to the picture which we just looked at, where for significant proportions of people with time-based repayment systems are having to find numbers 20, 50, 100% of their incomes to pay their loan. If they had income contingent loans designed like they are for the countries that I've listed there, the numbers would never be more than 10%. That's a really big deal. And it's the fact that these repayment burdens are set by the system is what explains the lack of hardship for the repayment of the debt, and indeed the lack of anxiety, and there won't be any default. And I'll explain that more in a minute. Next slide, please. So what does this mean for defaults? Now, we could spend hours and hours talking about what default means. So this is a bit of this is kind of a bit on the glib side, because default is a kind of hard concept to measure, and it differs depending on a country and depending on loan systems. These data are essentially the proportion of people with a debt who have made no repayments for, I think we're talking about 2.5 years. I'm not sure about this, and they will differ. They're basically people, though, who you'd expect over this period and beyond will not be able to contribute anymore. The numbers are highly variable, and they're also extremely hard to get. In some countries, they don't publish default rates, and in some countries, in Thailand, for example, my colleague and I had to work out default rates from looking at expected repayments compared to actual over several years. It was hard work, and that's why the ranges are so big. We're just not sure. But we don't have to be that sure to know that these numbers are very big. 20% in the US. Colombia, maybe at least 40. Thailand, I think it's closer to 70. Malaysia, about 50. Canada is relatively low, but it's still 15%. These are really important data. They mean that for something like 9 million people in the United States now have officially defaulted on their student loan and have now got damaged credit reputations. And those numbers for other countries are striking, and the consequences even more significantly adverse. For example, in Thailand, it is an illegal act to default on your student loan. There are hundreds of thousands of people who are waiting to be heard in the courts of Thailand because they could not repay the Thailand student loan. And as I said before, this means that the money doesn't come into the government. There are very important negative consequences of these types of loans, and default risks, therefore, are a profound issue when it comes to understanding time-based repayment loans. Next slide, please. What's the experience of defaults in countries with income-contingent loans? There is no default. There is no such thing as default leading to credit reputation loss in Australia, England, New Zealand, Hungary, any place where there's a universal student loan. It doesn't matter. No one gets labelled with default if they don't pay. Some people in Australia could spend 5, 10 years not paying any of their income contingent loan, and it has no consequence for their credit reputation. It doesn't have any effect at all on their access to borrowing in the future. What a big deal I think this is. Next, it's a zero risk for borrowers with income contingent loans. I might say it's something that really doesn't get that much attention in popular debate, but to me, the economics of this is about insurance, and this is really very significant in my view. Next slide, please. This is a bit of fun, really. The world is so horrible. Can we have a little bit of fun? I saw the front cover of the New Yorker magazine a few years ago. Next slide, please, and it looked like this. This is the way that the New Yorker magazine characterised student debt in the United States. That is, it was kind of inhuman. And if you look at what's going on with these horrible creatures with a very threatening colour, they're treading on people's heads. They're ruining their credit reputation. And somebody said to me, can you put that in an animated way? And I think the best way is the next slide. Thank you. It's reasonable to think about a time-based repayment loan, and that's how I think it's reasonable to think about income contingent loans. That's because one can ruin you, and the other one is just kind of cuddly and okay. I now want to spend the next few minutes just talking about student loans in the time of COVID-19, because this is what has motivated this whole get-together. Well, it's not exactly together, this whole gathering. What's going on at the moment is there major disruptions to the economies of the world because of health restrictions. It's a very unusual, in my head, a very unusual recession. It's come about because of the necessity to restrict business. And what that means is that there will be very high levels of unemployment, extraordinary, certainly bigger than what happened 10 years ago, and possibly as big as what we've seen in up to the last 90 years. What does this mean? I said it at the beginning, it is so important to keep on reinforcing it. This is the worst time in history to graduate with a time-based repayment system, because the chances of you not being able to repay are higher than they've ever been. And as I've said, that can be the end of your credit reputation. It can also be extremely important for governments to declare people in default on student loans, which was now much more likely because of their incapacity to find employment, and thus the relatively low likelihood that they'll be able to repay on time their debts. What does this mean? Just at the time when governments need the resources to finance the expansions which are completely essential for dealing with the recession, then they've got less revenue than they otherwise would have. So it is the worst time in history for borrowers of tax-based repayment loans. It's a very poor time for any student loans in terms of government. But if you want to think about the insurance benefits of income contingent loans, think about right now, because there'll be a very substantial proportion of people who won't get jobs under either loan system, like in the United States compared to England. But it's the people in the United States with time-based repayment loans who will then be in trouble. The ones with income contingent loans, they will not be in trouble. So income contingent loans, because of their insurance, protect people from the adversities of recession. And we know that the world is fragile. We know we can't predict these things. Never before has that become more obvious. Income contingency for the borrowers. At this point in economic history, I could only use the word profound. Next slide, please. So Harry saw this article that I'd written with my friend and colleague John Pickett. I've been thinking for a very long time about the use of contingent debt instruments for a whole host and colleagues and I, and some just all by themselves, have worked extension of paid parental leaves or income debt to collect low-level criminal fines so that people don't get put in jail, as they do in my country, for non-payment of fines. Again, the insurance of that. For the financing of drought relief, in Australia, we've given farmers who are lifetime advantaged in wealth terms very large numbers of dollars as grants when they could be paying them back when things are fine. And we've invented revenue contingent loans also for the financing of the payment for poor people of solar energy devices. One area in which we've just recently done quite a lot of work because of COVID-19 is on the revenue side, revenue contingent side for businesses. At the moment, the governments all around the world are giving hundreds of billions of dollars to try and stave off the recession, and indeed they should. But they're hugely expensive for future budgets, and it's going to be extremely difficult for this to be maintained beyond the short run. So the possible way to suggest about how we resolve this would be income contingent loans like the HEX system for the unemployed. I can talk about the design issues later. You give people who have got no money now $5,000 and say, you need to pay your rent, you need to pay your school fees, you need to do whatever, you need food, for example. Give us back the money when and if you can. Again, the insurance system. I think the most important thing we did, though, was with respect to business. We could offer money to businesses currently who have revenue and say, we want to help you now. In the future, your revenue will recover, and that's when you can pay it back, just like income contingency. We've done the modelling. The modelling is completely straightforward. If you cap the debts and make them income contingent with fairly conservative assumptions about when you get the money back, even at 5% of annual revenue, it's all there within a few years. These are unusual ideas, and I assure you that there's tons of writing that I can share with you. At the moment now, I'd like to move on to the next slide, which is really important for the world, in my view, the World Bank, because it's about collection and administration. Next slide, please. This is a slide which I think is likely to be of most interest to the World Bank in terms of the practical implications of having income contingent loans. In Australia, it's very simple because we use employer withholding. The tax system is pervasive. It works extremely effectively. Employer withholding does exist in other countries as well. And we need to ask the very important question, what about the informal sector? Because countries that we've worked in, Colombia, Brazil, Thailand, Vietnam, and Indonesia, have very large informal sectors. I would like to point out that that's typically where the graduates are not. But the person who I think we're now going to have after Harry's comments is Professor Lorraine Dearden, who's looked at this topic in a lot of empirical depth with respect to Colombia. So let me finish now. It's been an interesting journey. Thank you so much, Laura Lee. I know I've sounded impatient, but it has been. We got through this bit. So thank you very much for tuning in, and I'm very pleased to help with questions later on. And now I'm passing back to Harry. Thanks.
Thank you very much, Bruce, and I'm really glad that we mastered the technological challenges. You already handed back to Harry, so I'm also handing back to you, Harry, and then we go to Lorraine, and then we have time for discussion with the colleagues. Thank you. Harry, maybe you allow me, before we get started on the discussion part, I just would like to acknowledge that we have guests today from Kenya, Mr. Charles Ringera, who is the director, hello Charles, of the Student Loan Board in Kenya, and we also have participants from the ministry in Tanzania. A very warm welcome to all of you, and thanks for connecting. Harry, over to you.
Nina, I'll be brief. Thanks a lot, Bruce, for an excellent presentation. I think the current crisis and the recession that we're going through bring the issues of student finance to the fore directly. Implicit in everything Bruce said today, there are really only three sources of funding for higher education: general tax revenues, private spending, which obviously raises equity concerns, and third, future earnings, which are new sources of finance, and really the only new sources of finance that we have. And Bruce, in his presentation, gave us all the reasons for income contingency and for their benefits. I think the point that Bruce made that's very clear is that the traditional student loan systems will hurt students much more during this crisis as they have during all recessions. If you look at the earnings profiles for educated people, they will suffer during crises, but in these time-bound traditional student loan systems, the repayment will come to hurt quite a bit. So the case for income contingency is pretty clear. It provides the insurance, as Bruce said, for both the borrowers and lenders. There are no defaults, it's recession-proof, and so on. And we are still at a time when the returns to higher education are quite high. So it makes a lot of sense. The questions, two or three questions that I have, and points that I'd like to make very quickly are: if you have student loan financing, it seems a no-brainer that it would be income contingency. The question then is, why don't all countries have income contingency? I would offer three reasons that are also three questions to Bruce, Lorraine, and others, and also to the experts from their countries. The first reason is the capacity to collect, and this has to do with how easy it is in a given country to identify the taxpayer in order to collect the loan. And this has to do with the capacity of the tax system. It has to do with the nature of the labor market in the country. What if many workers are in the informal sector? So what do we do in those situations? The second reason I would group it under the title of politics. Politicians like to make announcements about higher education financing. Calls like, we will lower the interest rate for certain groups of students, or we will have free college, or we will reduce the payments. And income contingency kind of takes that out of the hands of politicians, or at least makes it a little bit more difficult. The third reason might be financial interests. Why in countries that don't have the taxation collection issue do have student loan programs? Why the traditional ones? Are there any financial interests in countries to keep this system where you have a combination of perhaps government agencies, private banks, and the collection that might profit from defaults and the selling of debt? So to what extent does this limit the ability of countries or the interest of countries to get into income contingency. Another question for Bruce, and specifically about the Australian experience. I am sure that some people are thinking, why don't we just have free higher education? I don't think there's such thing, but anyways, free of tuition. Australia went from, I believe, before 86, a system of free education, and decided to go for tuition. Why? What has been the outcome in terms of equity? Are there more students enrolled in higher education in Australia today? Are there more students from lower income family backgrounds? Another question for Bruce is on other forms of using future earnings to finance higher education. Within the category of income contingency, there are the private sector alternative, the human capital contracts. We have a couple of, at least a couple of companies that I know of that are doing this. So it's the same concept. You pay back based on your future earnings, but instead of paying it to the to government through the taxation system, private investors take an equity stake in your future earnings. And here, the difference between the income contingency that we have in some countries and the human capital contract would be that you have private investors taking the risk, and you create more, I would say, information about the value of different kinds of degrees, and creating another market for higher education. Is this a realistic alternative in some cases? So many more points to make, but there's a great group of presenters and participants here, so I will leave it at that. Thank you very much for an excellent presentation. Back to you, Nina.
Thanks a lot, Harry. It's Nina again. I would suggest, Bruce, that we turn to Lorraine now and hear her response, and then also collect a couple of questions, and then later on you respond to the various points which came up. I'm also happy to summarize them, but it's up to you. If you would prefer to respond immediately, that's also fine. Otherwise, we collect a bit. I cannot hear you. You might still be muted. It's okay. We can hear you again. Bruce, is it okay if I collect the questions and you respond at the end? Yes, excellent. Let's do this. Lorraine, I turn over to you.
So there was a couple of slides at the end of Bruce's presentation that I was going to speak to. I don't know if you could get those up again.
Lorelei, would you be able to help with this? That we go back to the end of the presentation.
So I think my issues are very similar to the issues Harry raised. So I've been doing a lot of work in a number of emerging and developing countries on designing income contingent loans around the world. And in every country I've come, I've worked in Malaysia, Japan, Brazil, Chile, and I'm doing a lot of work at the moment in Colombia. And there's always the same themes that come up. So the idea that ICLs won't work because there's a large number of graduates in the informal labour market. So that is a real issue in Colombia, Brazil, Malaysia, and other countries. So it's the slides are further down. Lorelei. Yeah, that's great. Thank you. There's also, as the issue Harry raised, it's all very fine in the developed country. You can't collect through employer withholding. It's not possible. I'm not convinced that that's true, and I'll talk about Colombia in a minute. But it is an issue. Is there some sort of established collection mechanism which could possibly mean that you could get loan repayments through employer withholding? I think there's another issue which wasn't measured, but this is a real issue in Colombia and Malaysia, is that part of the insurance mechanism of ICLs is that a significant proportion of borrowers will pay back more slowly than they would under a time-based repayment loan. And therefore, the speed at which the collection agency or the student loan company or the government gets revenue will be slower, which in the short term will mean that there will be short-term funding issues. And that is a big issue. It was certainly a big issue in Malaysia, and it's certainly a big issue in Colombia. Long term, it won't matter, but there could be short-run revenue implications. And as Harry said, I think in a lot of countries, if there's default, typically what happens is that the student loan company or the government sells off the student loan book at a huge loss. But there's lots of vested interests in who make money out of selling off, from these bad debts. And so, it is quite politically difficult often to get these things true. And I think the politics of it is very, very difficult. So if you could go to the next slide, please, Lorelei. But so I just thought, I'm doing, as I said, I'm doing a lot of work in Colombia at the moment. And interestingly, we've got access to fabulous data. So every single loan holder in Colombia, student loan holder in Colombia since 2003, we have been able to link their to their social security payment system. So that's from 2009 to 2020. So Colombia's income tax collection is not very sophisticated, and it's only people earning quite a bit of money pay income tax, but its social security system is very well developed, and its health and pension social security system. So we've been able to link all the borrowers in Colombia to their earnings if they pay social security payments. So we can actually see if Isitex loan holders are making health social security contributions. And what we find, we for instance, the oldest cohort first took out a student loan in Colombia in 2003, so we can follow these people through to about from the age of 25 to 35. And what you can see is, whilst only around 30% of, at any one time, at 1 month, we've got monthly data. At any one time, around 30% of loan holders are not contributing to Social Security. This varies by age, it goes up by age. But for the 2003 cohort, over 95% of the loan holders have been in the formal labour market at some stage between January 2009 and February 2020. So this is really important. Looking at a snapshot of a point in time is not a very good indicator of whether an ICL will work. And in Colombia, the big problem in terms of not being in the formal labour market is dropouts. They've got a very, very high dropout rate. But for graduates, the proportion in the formal labour market is quite high. So this is really important. And every country is different, but until you see the data, you don't have an idea. Now, in Colombia, if, like I said, if somebody defaults on their loan, the government sells off the loan. So actually, I think we haven't done this work yet, but once we take into account default rates and what actually people pay, I think it will be very, very easy to demonstrate that a well-designed income contingent loan would have much better recovery rates than TBRL loans and much lower taxpayer subsidies. In Colombia, it's a mixture. They don't just get all their money from the government. They take loans out from the World Bank, from other banks. But I think the early work suggests that an income contingent loan could be much more efficient, involve much less loss. So I just wanted to point out that every country is different, and you need good data and understanding of institutional arrangements, but it can generally result in a much more equitable and efficient loan system. And my final point, I know Bruce is going to talk about this in the Australian context, but in the UK context, we had a similar situation. We had no fees, and then we introduced fees with income contingent loans. And we also introduced income contingent loans to support students at university. So the idea was, if you came from a poor background, there was no upfront cost to university, because you got an income contingent loan for the fees, and you got a grant and an income contingent loan to pay for your university. So university was free at the point of access with the income contingent loan. But then how much you paid depends on how well you do in the labour market, because where you come from does not necessarily mean where you end up. So the idea in the UK was to make it free at the point of access, and actually the upfront support for students from poor backgrounds became much more generous than with free higher education, because they got much more money to live on. And in the UK, the biggest increase since the introduction of fees has been those from the poorest socioeconomic groups. There's been virtually no change at the top socioeconomic groups, but it's almost been a doubling of participation in higher education from the poor socioeconomic groups. So I think that's an important point, whether it's free at the point of access versus free. So I'll be quiet then.
Thank you very much, Lorraine. It's Nina again. Hello. I would now turn to our colleagues from the Higher School of Economics in Moscow. Isaac, maybe you have a question you would like to ask, or one of your colleagues. If so, this would be a good moment. And then I summarize the questions, also those which I received via WebEx, and we spend the remaining part of the time for discussion. Okay, if there are no questions from HSE colleagues, if you have questions, please feel free to send them via chat. Otherwise, I would summarize a few quick points which came up. I mean, of course, both of you, Harry and Lorraine, you also added to Bruce's presentation. Thank you very much for this. However, there were also a couple of questions, and some which I also received in writing. So I would make an attempt at summarizing this. But Bruce, maybe you are picking up on different points. Then, of course, this is also great. So we had two issues which are more related to the general environment in which basically income contingent loans are discussed. And one point came up in Harry's response, which is the whole question of free higher education. And Lorraine clarified this in her response, saying free at access or free in general. And Harry asked a specific question: what was the Australian experience with this? Did free higher education indeed lead to more equity? And coming myself from a country which has reversed reforms and has moved away from fees again, I also have a view there. So this is on the general environment. We also received some questions by Charles Ringera, the director of the loan board in Kenya, who also asked a more general question on the connection to the public good aspect. Don't we need to make the case for subsidies for higher education at the same time as we think about student loans? So this was one of his questions. That's on the general environment. And Harry asked a question about the alternative option of having loans or loan models with the private sector. He mentioned the human capital contract. So what are the pros and cons of this option as compared to the public sector taking care of it? And the rest of the questions, I would say, were more closely related to the technical aspects of income contingent loans. They are related to this question of informality. How do we deal with it in countries which have a lot of informality? Charles also asked this question. I would like to add, how do we treat mobility? I think I remember that in the New Zealand context, this was a challenge, that many people leave and you try to find them, you need to trace them in order to recuperate the funds. And Lorraine also added on the point that there are specific challenges in developing countries. And of course, if there is a slower repayment, and there tends to be a slower repayment in the model which we discussed, then it also means that the revenues are coming in more slowly for the government, which presents a couple of changes. I would leave it like this, and Bruce, please pick a few points, or maybe all of them, and we are keen to get your view on this. Thank you.
I could say a bit about the Australian experience. So there was a queue for university in the Australian system, but no extra government funding to make it bigger. So the Australian introduction of fees was about expanding the system so that it could get bigger. And indeed, I think over the next 10 years, because it introduced fees and students started contributing, it doubled in size. So that was the motivation behind the Australian system. I think Bruce.
Yes, and Lorraine, what's your view on the point which Harry raised? I mean, the whole issue around.
So there's a problem, right? Because with human, they're going to cream off. These are small scale, right? And so they tend to be concentrated, I would argue, amongst, they tend to have to do much more selectivity in terms of who they get, because if they don't pay back, then they don't get the revenue. And they have the same problem. I mean, I think they very much are based on having trust between those who lend them the money for their human capital contract and stuff. So it's quite a lot of work. So I think it does work quite well on a small scale. I think there's an issue about the scalability of it. And so I think that is the key issue. I mean, Muhammad Ali famously got a human capital contract, and that was a hugely incredible, decision. But I think there is an issue about scalability and, collection. And I've talked to a number of people who are involved in these human capital contracts. I mean, getting the collection right is an issue, which, if you can have employer withholding, is not an issue. So, I mean, I think there's a role for both, but I don't think it has the scalability that an income contingent loan has.
Okay, thanks, Lauren. That's really clear. Could I invite you, from your experience working in different countries on this topic, also to answer the question of the colleagues on different challenges to the model, and two came out quite prominently. One is related to informality, and the second one is related to mobility. So what do you do if you have a hugely mobile labor force and suddenly people are gone? How do you find them back and keep the system working?
I mean, Bruce knows more about this than me, but I mean, that was a huge challenge, I know, in New Zealand, and also to a lesser extent, Australia. So now in Australia, they have a robust system that if you're leaving the country, you have to inform them where you're going, and you sign an agreement that you will pay back on your loan. So, it is very country specific, but I don't think it's an insurmountable challenge. It does, of course, involve more administration, which is, one of the huge advantages of an ICL, but it certainly was a problem early in Australia, but I think it's something that they've now actually got quite a good handle on. I mean, I actually am from Australia. I actually went to university before there were loans, and on my Facebook page, I can consistently get up, if you're an Australian who still owns a student loan, you need to notify the tax office, and you need to do this. In New Zealand, I think they went down more draconian routes, and if you left the country and you didn't inform them, then they had quite harsh penalties. But I do think there are ways of dealing with that. So I don't think that's an insurmountable challenge.
Maybe one footnote to this question, and then we move to the informality aspect. is it enforceable, or is it just enforceable if people return to the country? Because the question also came up in terms of labor mobility here in Europe, people from outside the European Union migrating to the EU. If a country like, I'm making this up, Serbia would introduce such a model, how could this be handled in practice, just in one line?
I mean, every country is different. I'm just seeing on the chat, you know, somebody saying that Belarus, you know, has a mandatory job placement to tie it. You know, it will depend on the legislation in the country. I don't know. I'm not well placed to do it. I mean, in the UK, anybody coming to the UK from Europe to do a university course was entitled to an income contingent loan for their fees. So lots of European students have income contingent loans. I think the repayment rates for those loans are different depending on which country you come from, and it depends on, you know, average earnings in that country. And so I'm not sure how that has exactly operated in the UK, but it's certainly been done. I know in Australia, as I said, they have a tracing system in place now. You could talk to officials from Australia how they've done that. But the other thing to remember with an income contingent loan, people were talking about subsidies for higher education. Most income contingent loans have a government subsidy, right? You can design them so they have no subsidy, but most have some sort of implicit government subsidy. In Australia, I think the subsidy is around 20%. So, and in the UK, it's higher because the student debts are most higher. I mean, there's a subsidy of around 45%. So there's still government subsidies involved. When I was involved in Japan, they were very keen that any income contingent loan had no subsidy. And there's ways of designing it. So the subsidy associated with your higher education system and your loan system is a parameter that you can, you know, build in and design a loan so that, you know, it has the required recovery rate. But most involve subsidies, as do most traditional student loans, because of defaults. So, you know, it's a policy question. Okay,
thanks a lot. We have very little time left, but maybe you could also say something around informality. Of course, it's an issue for many of the countries where we work in, and so a couple of questions on this.
I mean, you know, again, until you see the data, it's very hard to assess. And the work I'm doing in Colombia suggests that, you know, I'm pretty confident we can design a system. What it will mean is it just takes much, much longer for those who come in and out of the formal labour market to pay off their loans, okay? So it will take longer. But then you've got to say compared to what? And, you know, the compared to what is the really important thing. In the current system, if they're not earning money and not in the formal labour market, they're likely to be high likelihood that they've defaulted. And Isitex, the student loan company, isn't getting any money back and is selling off their debt at a huge loss. So I think it's really important. I don't think we have, you know, you really need good data from the country to understand how people move in and out, and ensure that you design a loan system that's going to work, and make sure that you compare it to the true value of the current loan system. So it's a difficult exercise. Every country is different, but I think it would be important to have really robust evidence on what it would mean in each country, and before, so that you could decide what is best. But it needs good data.
Okay, thanks so much, Lorraine, for helping us to
I'm sorry, I'm not as...
no, this was very helpful. Thanks a lot. We thank Bruce for his presentation, all of you for your patience while we were facing some technological hiccups, and also Harry and Lorraine for their response and for helping out during the discussion. I'm sure it's not the last event we are going to do on this topic. If you have pressing questions, please write to us, and I hope that Bruce, Harry, and Lorraine can help us to get these questions answered. And Bruce, I hope it's going to be okay with you that we send a PDF version of your presentation to the colleagues. We hope we will have another discussion on this. We really appreciate you connecting from so far away, and I'm sure your presentation will be very helpful for the colleagues. Thanks, everyone. Goodbye.
Thank you very much.
Thank you, Bruce. Thank you, Lorraine. Thank you, Nina. Thank you, everyone.
Thanks, Harry.